Well, it's absolute carnage on Dalal Street, not to mention the Asian markets which are down and out on a combination of factors including the Fed minutes as well as a sell-off in the property stocks in China. So for the frontline index, 5900 seems to be a far cry now. It's 5892. You've got the Sensex off by a good percent and bleeding for the broader markets as well. All of your sectoral indices are deep in the red, and in terms of individual stocks, you've got Jayaprakash Associates bleeding. Sesa Goa is down by 3%. Jindal Steel and Power, Hindalco, Tata Motors, DLF as well as Tata Steel. Unilever, Axis Bank, Reliance Infrastructure are also some of the heavyweights which are weighing down on the index. Gainers, honestly, is just a handful. You've got HCL Technologies, Bajaj Auto, Bharti Airtel as well as Power Grid among a few others that are holding up, and the market breadth continues to remain in favor of the losing side.
If we look at the currency markets, what you are seeing really is a mirroring of sorts in the currency markets of what you are seeing play out in the equity market. So equities under a fair bit of pressure, and that's playing out on the currency as well. So 54.48 to the dollar. This is something like 41 paise off from yesterday's closing level of 54.07. You are going to continue to see the rupee mirror the movement of the equity markets, and if you do continue to see weakness, I guess 55 to the dollar is a level that will be breached as soon as equities continue to slide further. In the fixed income markets, what you saw yesterday was a reaction to the government's announcement on Monday evening that they would cut their borrowings for the current financial year by 12,000 crores. You did see some reaction at the start of trades, but not very much. So you actually just saw the yield on the 10-year benchmark bond decline by something like 2 basis points or 3 basis points. It's climbed back now, so 7.81 is where it is at. So there still remains concern within the fixed income markets as to how the government is actually going to achieve all that, the fiscal deficit number which the finance minister has spoken about, the 5.3% number. It's being done almost entirely by cutting back on plan expenditure. What they'll want to see is where expenditure is being cut, whether it is productive expenditure that is being cut or whether it is recurring expenditure that the government is looking to cut. So all of this is something that the markets will want to see. For now, though, it is fairly quiet really in the fixed income markets. So 7.81% on the 10-year benchmark bond. In the currency markets, a weakness is what we're seeing.